Hey guys, it's Big Mike, and I'd like to thank you for being here today as always. Today we have Anthony from MarketDelta here to talk about how to understand order flow using MarketDelta Footprint. Anthony's a 13-year CBOT member, and he's also a professional trader and hosts the MarketDelta Trading Room every day. In the webinar, he's identified a few bullet points that he wants to talk about today, which include tracking buyers and sellers, what to ask when identifying them, how to execute your bias using order flow, and a discussion on context, not just when, but also where. As you guys have questions, go ahead and type them into the questions box, and Anthony will try to get those answered. Also, we have Trevor here, Trevor from MarketDelta, so either Anthony or Trevor will try to answer questions today. The webinar is being recorded. Like always, I'll post the recording sometime tomorrow. I'll also send it to MarketDelta so they can send it out to the members that are here from their side. And if you have time when you're watching the recording, do me a favor. If it's on YouTube, give us a thumbs up if you like it. If it's on BMT, fill out the feedback form right below the video so we can get some feedback for future events. All right, guys, and with that, I'm going to be turning things over to Anthony.
Thanks, Big Mike. All right, guys, glad to be here. I think Big Mike gave a nice introduction, so I don't want to cut into that and bore you with my bio. I'll talk a little bit about that in a few slides. I just, again, we're going to be content-driven here today and just kind of get into what we have here on this Prezi. The iceberg template is to show iceberg orders came into existence about, I don't know, 2003 or 4. That was not a term 20 years ago. It became a term because there was more to meet the eye, and we'll talk on how technology allowed bigger traders, institutions to hide their orders. We'll kind of get into that. Like I like webinars with just a disclosure, and the way I do it is talk about that if you don't know what risk is, how are you going to manage it, and managing risk is obviously essential. What could you expect out of the next 45 minutes or an hour? And it's about what's above the surface, what is obvious in what you guys are looking at, not you guys necessarily, but the overall market participants, where they think this business is easier than it is. What's above the surface is traditional charts, education. What's below the surface is how to track buyers and sellers, to know why they're buyers and why they're sellers, and we'll kind of tackle that. Then I'll introduce the footprint. Every time I say the footprint, which is obviously something on MarketDelta charts, think of order flow. The footprint is the tool I use to read order flow. And then we'll kind of wrap it up with showing how Trevor and MarketDelta came and took a platform and the footprint, put them together, and that's MarketDelta Trader. I'll show you that and some of the reasons why and how to use it. Some of my, what people have called Anthonyisms are just, I'll kind of tie in, and these are quotes that, I use to convey a point, cement a point home. And when you understand the why, the how becomes easier. Remember my dad telling me, if you know why, if you know how, you'll have a job. If you know why, you'll be the boss. In trading, it's not only important you know the why, it's essential. You can't just have a job knowing how to trade. You got to know why things do what they do. So let's jump to above the surface. This is a picture that anybody who's been to previous webinars of mine have seen. I call it education saturation. This is one of the few industries and businesses where you don't know what direction to go when you get into it. When you become a pilot, you go to flight school, and there's a certain progression. If you're a financial advisor, a doctor, a lawyer, you come to trading, and it's a profession, you get pulled in these different directions. It's not necessarily your fault or anyone's fault not knowing which is the right direction. So it's important to identify that, because you can not only waste time and money, but most importantly, you take back and you get pulled into a direction that it's tough to kind of get back to what's important. The 3 concepts I convey, I'm only going to touch on 2 of them today, are order flow, where traders are stuck. The first one is market relationships, when I'll cover order flow and where guys are stuck. Now let's jump right into it. Above the surface are traditional charts like candlesticks or bar charts like the one you see on the right that I just popped in there. High, low, open, close, swing highs, swing lows, and all the rest. But again, a lot of information is missing from just being able to look at a high, low, open, close type of environment. And then traditional price ladders. And I just got a small picture of it. It's not necessary to see what's actually clear in that. I've got some slides further on. But the traditional price ladder, one used when I started trading, looks very similar to this 13 years ago, 12 years ago, where, you know, that was enough to read order flow. And then as 03 turned to 04, you had to see a little bit more. You had to keep track of what was going on at price rather than just price, bid, offer, and quantity at price. So again, these are your traditional above the surface measures that people use. Now you could tie in market profile, you could tie in volume profile, stochastics, moving averages, and anything else under the sun. But if you don't know the why, then the how becomes impossible. The how, the why rather is buyers and sellers, big orders, big traders, and in context, like Big Mike touched on, where it's going on. So just another couple things about me. Mike touched on it, so I'll roll through this slide. I was a CME arbitrage clerk in the Eurodollar pit. That's me trading in front of my screen. CBOT member since '99, prop firm trader since April of 2000. In fact, 4 days ago this year, April 25th, I put my first trade on Euro stocks, April of 2000. This is the floor, the pit, which is no longer there. It's consolidated on the board of trade. That's the Eurodollar complex. And I sat way back in this little perch looking at guys way in the options pit. The reason why I bring this up is because the same concepts and techniques that these guys had an edge or advantage off of you if you called in your orders is what you need to look for on a screen. And that's part of this webinar. What to look for on a chart, where, why, and how you see guys get stuck is what these guys seen front and center. Looking at the boards, looking at other markets, being able to identify when the pit was too long or the pit was too short. So that's what's important. Another Anthonyism, so to speak, is sometimes trading is like shooting fish in a barrel, and sometimes you're the fish. Everyone feels like that, especially if there's a sense of randomness. That's what this webinar is about. That's what this forum is about. It's about a community to keep guys feeling like the fish. Stripping out the randomness is what's important. And so let's get started. I touched on this, how to track buyers and sellers. I don't know if this is elementary to some guys, and it isn't to others. And I knew this from constant contact with individuals and that are on many different levels of experience, success, failures, years of experience, years of education. And I have to go over this in order to make sure that all the I's are dotted as we go to the next slides. How to track buyers and sellers, bids and offers, okay? And I'm going to use Big Mike. If you don't mind, I'm going to use you as an example. So what we're going to do here is 43 quarters are bid for 301 contracts. If Big Mike, who probably trades 25 lots, well, let's keep the math simple, trades 20 lots, put in a resting bid right in here, this 301 for all intents and purposes would look like 321, right? If Big Mike says, you know what, I just want to buy the S&P, and again, this is the E-mini S&Ps, and I want to buy it. The best offer is what? 43.5. That's where people want to sell it. Big Mike clicked a buy market order. He'd get filled at 43.5 with his 20 lot, and this 250 would look like what? Would look like 230, because Mike took off 20 of them. This yellow would show reflect the last traded price of 43.5. The reason why I say this is that's why, and that's the beginning part of the footprint, is you have to know if a market is bid or offer when you're looking at the quantity that trades at that price, because those are identifying the aggressive buyers. So I'll say this, that the footprint is aggressive buyers and sellers, and the ladder or the dome are the passive buyers and sellers. The aggressive guys in any business are the ones that are going to give us clues as to what's going to happen next. You guys are driving down the expressway. Isn't it easier to assume that a guy who's just flying in and out of traffic and is reckless, that if he gets into an accident, it wouldn't surprise you? It's a little easier to make those assumptions when you see something stick out. It's the aggressive players, big or small, that you want to keep track of. That's what the footprint does, okay? So bids and offer, again, this applies to any market. It's important to know when you're starting to track quantity is to know if that market was bid when you seen that traded size or offer. It's going to totally, and pulling all the assumptions out, show you aggressive buyers and sellers. Just like the example with Big Mike, he's an aggressive buyer. This 250 looks like 230 because he just put in a 20-lot buy order. And so what would happen here on the footprint, and I'm going to cover this in a little bit more detail as we go along. So this 102 would look like what? 122. It would account for 20 extra aggressive buys that Big Mike put in. Now, we know Big Mike just bought it because that's the example. But because we know 43.5 is offered, we know someone aggressively came in and bought 20 contracts. The footprint, especially the footprint next to the dome, keeps track of that for us. So how do you know they're a buyer or seller? By simply knowing if the market was bid or offered at that particular point. Now I got to get off the screen here 1 second and click back on. This will go in and out. Hold on a minute. So another thing that resonates with people is this quote right in here. After you buy, you're a seller. After you sell, you're a buyer. This is going to segue us into the next slide. What does that mean? You know, I really could say it. After you're long, you're what? You're a seller. After you're short, you're a buyer. That's important because, and I'm sure a lot of you guys have automated strategies or strategy runners where when you buy something, it automatically puts in what? When you get long, you automatically put in your sells above the market for your profits and a sell stop below the market. Either way, you're a seller. After you buy it and get long, you're a seller. After you sell it to get short, you're a buyer. You guys know that, so you have to start thinking in terms of if most of the rest of the market opened up a long position, and they did it like Big Mike did at 43.5, and most of the rest of the market, in this particular case, are short-term traders, there is that element of them being too long. You don't want to be long with too many guys that are short-term. Short-term prices move and are influenced by short-term traders because there's a lot of us trading, especially the S&P minis, which is the most popular futures market that's traded. So again, you don't want to be long. Markets move, and I meant to put this in as a quote. Markets go up because markets bounce off the lows and go up, not because people are opening up long positions, because they're covering shorts, especially the shorts that were covered in the or put on in the hole. That's emotion. All right, that's one constant in trading. Since they were trading on the curb on Jackson and LaSalle 150 years ago to right now in an electronic environment. Markets bounce off of lows because too many people got short. And maybe they got short from above and they're covering for a profit and they see their profits diminish, or they're stuck in the hole and they sold it late. So just keep your eye on the prize that markets don't rally always because people are just getting long and everybody's happy. They rally because people are covering shorts. I got to say this now so I don't forget, but I'll say this to everyone, Big Mike, myself, Trevor, everyone in this forum today. What makes you think that we're so special that we're going to buy a market at 3 and people are going to come in after us and buy it at 4, 5, 6, and 7 so we could sell it at 8 and make 5 ticks? What makes you think that you're so special, that I'm so special? We're going to buy it at 3 and people are going to come in and buy it after us at a higher price. And it's because if we're right and if we identify value, people are going to come in and buy it at higher prices because they're wrong, because they got short at 1 or 2 and they're buying 4, 5, 6, and 7 because they're covering a short position. That's the why markets move. The how is, you know, how do I get long and moving average cross shows me that there's value down in here, and it's going to break out of a Darvis box, and it's a 618 retracement on a Fibonacci, and I put in 3 hours to distinguish this setup, so I can't be wrong. Let me get short here. No, you're short with the herd, you're short with the sheep, and therefore you're not identifying emotion. The analogy that I use for this, and then we'll go on to the next slide, it's a pawn shop. Said it before, I'll say it again. Pawn shop owner knows that the guy who walks in the door with a $10,000 Rolex is going to sell it a lot cheaper because he's emotional. That's what you have to identify on the dome, on the footprint, and on your charts, is where guys are going to scramble out of losing positions. Too long, too short. Let me just touch on and get rid of some of these. Let me just touch on traditional candlestick chart. Again, high, low, open, close. Sure, you could look at the volume profile on the right that I always show and have on my charts. I always have today's profile, for instance. I have previous day's profile here in the middle column and a running 5-day on the far right, okay? And that's information. I'm not a market profiler or a volume profiler as an expert. However, I do use it to create a bias. I also use it to create a bias as to where other market or volume profilers are too long or too short. It's the best way to use any kind of strategy or build it, again, is looking at a chart to see where traders are stuck the wrong way. But just in a traditional candlestick chart, sure, you could see where moves started to the downside in this particular instance, where they ended and bounced, right, where the swing lows are here and here, right? So there is good information just on a traditional bar or candlestick chart. But what's important is context. When I scroll my wheel and it turns the footprint into a candlestick or a candlestick into a footprint, I do it just to get context. So this is what I mean by that. When I'm looking at a move, like I had talked about, where are guys stuck? I don't want to see guys necessarily after if you just look at this particular picture, where's this? Oh, my pen went down. 78 even. So this particular move started at 78 even. All of a sudden, we're 4 points lower, right? And we start moving down. I don't know, neither do you guys know if that's the low. We know it now after the fact, but after a 3 or 4 point move, do you want to sell it? You could. Maybe there's something that shows you want to get short. The thing is, you got to know your risk. You got to know that the market already broke 4 points. There's already people short at better locations than you, and they're already thinking of covering. When you cover a short, what are you? You're a buyer. Too many buyers, and we're going to bounce. I like to look for guys who sell it, not understanding context, and try to see where these big buyers, where everyone else might, or these big sellers, and everyone else might sell it with them. And we already broke 3 or 4 points, or 50 or 60 cents if you're a crude oil trader, or 20 or 30 ticks if you're a 60 euro trader. Everything has a big move attached to what is a decent move. 4 points is a decent move in the S&P, especially in the matter of just 10 or 15 minutes. So I'm a contrarian. I'm looking for where markets want to turn, and I think that when you use context, when you say, you know what, yeah, it might be a good place to get long, certainly a good place to cover a short that you might have been fortunate enough to put on up here, but when you start understanding what to look for in the context of where we came from, now you're not only staying out of potential losers, but you're having better profit targets. So you're not dealing with what I call emotional capital. And I don't want to get too much into that because that's essentially a webinar in and of itself. But what emotional capital is this in a nutshell. If you sell a market at 15 and you want to get off at even or get out at even for a 15-tick winner, and it goes 13 ticks your way, and comes all the way back up to where you got in, how do you feel? You don't lose any money. In fact, you might even make 2 or 3 ticks, but you were 2 ticks away from your profit. You lost a lot of emotional capital. That's how everyone's going to feel, and it happens to people that look for big winners all the time. I'm not against going for big profit targets, but if you can't get 3, 5, 6, 7 ticks, what makes you think you're going to get 20, 30, or 40? I always tell people, start where you could be where you could strip out randomness, where you can get consistent with profits and then push those profit targets out. Pay attention to the present. Pay attention to order flow on highs and lows after a big move up or a big move down, and make sure that you're just not relying too much on market or volume profile, which is the past, and you ignore the present. All right, the past is useful, but so many people pay attention and look at charts and look at and just look at certain lagging indicators that is a reflection of what already happened, and they neglect the present. So don't just use the past to predict the future. Concentrate on the present. And you could do all your homework and all your preparation in the world to prepare for a day, but you can't assume to know where big buyers and sellers might come in to create an important area in a market. You have to prepare to look for that. You have to prepare to know where you see it at, but you can't necessarily say that you know 88 evens today or 91 evens today was going to mark maybe the high of the day. Okay, and so there's a lot of real-time analysis that goes on, but just to understand context of where we were when this market did what it did and what you see. Now let's go into actually identifying these big buyers and sellers for a second. Let me erase some of these drawings, Mike, and then we'll jump into it. All right, let's go to the next slide. A little deeper into this iceberg and talk about the footprint during a rally. I give you an example of after a break in that traditional chart, but let's just look at the footprint. And I just cut out a section I use for point and figure. And without getting into what point and figures show us, let's just, if I were to draw a line chart, Big Mike, into this chart, what it would look like is this. The market rallies straight up to here, rotates down 4 or 5 ticks, and re-rallies to here and puts in the high of the move here. So the previous high of the move was here, and then the retracement came back about 4 or 5 ticks in the S&Ps, and then re-rotated back up to here. What do we see? Do you see something that sticks out in context? The market started from down in here, like 4, let's say down at even, 4 points lower, and now all of a sudden, let me erase these drawings. And now all of a sudden what we have here is a nice imbalance, 4,400 by 7,300. We're starting to safely assume that there's some aggressive buyers after a 4-point rally that might not be getting any love, might not, when you see big aggressive buyers come in, what should happen? Market should rally. So the most important question you ask yourself is, all right, I got to look for big buyers or big aggressive buyers, but then what does the market do after you recognize them? If you just try to look for big buyers and sellers, and you don't ask yourself then that question, then it's ineffective. All right, that's one of the most important questions you'll ever ask yourself is not just recognizing buyers and sellers, but what does the market do after the market now sees this big buyer come in? Does it get absorbed? Does it hesitate? Did we just rally 4 points? So on and so forth. Secondly, with the footprint, and I think a lot of people get distracted with this until I tell them that you don't have to analyze every uptick and downtick. There's not important information at every tick, right? So you just, again, inside a range, if a market's just chopping sideways like this and you see a big buyer or seller come in, is it important? No, probably not. Most of these numbers you could just disregard and move on and see something that sticks out. And that's step 1 of order flow. And what sticks out is aggressive buyers, in this case, that has a nice imbalance, and it begins to have you scratch your head and say, is this market getting toppy? Is this market getting heavy? And is that example that I talked about a few slides ago, is it getting too long? Market will break off a rally and retrace lower for one constant, too many longs. So if I pull up, let me go back and get rid of some of these drawings. So if I pull up the subsequent bar that comes in, right in here, what we see is the market rally 4 points, come off after this imbalance. Does this happen every time? Of course not. But does this get you to not only create a bias that the market's getting heavy, but execute it? The market is waving to you saying, if you're bearish and you want to get short, this is your price. You guys that have heard my previous webinars, I probably say in each one, if I were able to develop an indicator that physically had a hand that came out of the monitor and cracked me in the head and said, Anthony, you want to sell it? This is the price to sell it. This big imbalance, or a big buyer, and that's that chart that I just popped in the lower left. This is a filtered footprint of this chart here in the upper right. And I filter it for a certain size that I deem to be big size. So when it's blue, it's a big aggressive buyer like Big Mike was in that 20-lot example, only to the tune of a couple hundred or more, which I deem to be big size in the E-minis. So when you see a big imbalance like this 4,400 by 7,300, and you see a lot of it has these aggressive buyers, bigger buyers, do you want it, the simple logic, or just you know, you have someone sit in here and you come in here and you go, well, big buyer, I want to buy it. No, big buyer after a 4-point rally and the market can't seem to stay bid. I not only want to sell it, I want to sell it with 2 hands and both feet, because that's getting more sheep in the herd, and you're in a helicopter above that herd and you see a cliff. They don't see it, you see it. Stuck traders, markets rally and pull off those highs or bounce off of lows on a break because of too many longs, too many shorts, too many longs in this case. Now you could come in here and say, well, how about this guy in here? Not as much, because maybe it was inside a range based on what's going on previous to that. You know, how about this guy? Yeah, I like to see a big seller to finally defend a rally. That's important to me, right? So I have alert levels of support and resistance, and anybody could create their own levels. I don't care if they're LVNs, HVNs. It's all about executing your bias. So after a 4-point rally, guys, if you see big sellers that are aggressive that step in, that's the hand that comes out of the monitor and say, sell me. If you see, and I like this even better, a 4-point rally, it's in an alert level of resistance, and I see this dynamic take place. And in the trading room, this is all stuff that's real-time analysis. It's easy to throw up these pictures, but it's more important to, on the fly, be able to have time to create the ability to execute your bias. You could be the best predictor in the world and not make any money if you don't execute. Too many people like to tell me what the weather's going to be in 5 days. Tell me what it's going to be in 10 minutes. And that's how you make a living. Tell me what it's going to be in the next hour. I don't care what the weather's going to be at the close tomorrow. I care what it's going to be at 9 o'clock or 5 minutes from now. It's invaluable information. Don't make it as hard. I mean, this business is hard, and people make it harder. Make it easier on yourself. If you can't predict what's going to happen in the next 10, 20 minutes, how do you expect to predict what's going to happen in the next few hours? How are you going to deal with the emotional capital of seeing a 20-tick winner turn into a 2-tick winner? So that's tough, and that's the reality. The Mary Poppins version of trading is to see a nice looking chart that just did this and say, I'm going to be a trend trader. And wow, yeah, it's going to look good and that's going to be great. You know, the only problem is that chart patterns don't look like this. Secondly, when they actually look like this and you say, I'm going to be a trend trader and I'm going to buy it here and I'm going to sell it up in here, next thing you know, you see it get kind of close and see a nice 15, 20-tick winner. You end up selling it down here because you don't want a winner turning into a loser, and then you see it go. That's the reality.
Hey, Anthony.
Everything else is just fiction. Go ahead, Big Mike.
Before you go to the next slide, there's several questions, so I thought this might be a good point to address some of these. Let's see. Robert is asking, he says, or he's commenting that resting buy and sell orders are confusing. He initially thought that sell was red and green was buy. So can you clarify that for everybody?
Well, resting orders are passive, right? And so aggressive are people who lift an offer and or hit a bit. Let me go back to the Dome, Mike, because I think that might help people a little bit more just understanding what it looks like on a price ladder. So if I go back to this Dome and I go, yeah, resting buyer would be a guy that's laying his bid at 43.25. But he's blue on the footprint chart if he lifts an offer and buys it at 43.5 and does it with a market order. And it goes back to the footprint is showing you aggressive buyers and sellers, whereas the order book is showing you passive buyers and sellers. The reason why, in my opinion, and the opinion of every guy that I know that trades professionally and has for a long time, is the aggressive guys are the ones you want to track unless you see an iceberg forming, and therefore you could see some resting buyers or sellers. They're still buyers, but they're resting buyers. There's more of a tell to where guys are stuck with aggressive buyers or sellers. So I hope that answers this question.
Yeah.
While it's important to know where resting buyers are, right, in an iceberg fashion, aggressive buyers are the ones that show up on the footprint, Mike.
Okay, let me just take a couple more questions here. Mark is saying, can you explain what it means that the market can't stay bid?
Let me go back to this chart again. Market can't stay bid. So let's say this 43.5 is offered right now. Right, Mark? Is that his name, Mike? Is his name Mark?
Yes.
So this market is offered at 43.5, okay? It can't stay bid, meaning let's say this guy comes in and he buys 200, and the market, he buys 300. The market goes 43.5 bid, and then bam, it goes offer again. Buys another 200, goes 43.5 bid, bam, it goes offer again. It can't stay bid, and that's where you're showing and seeing a market go up or down. If a market goes bid, in this case, what would happen? 43.5 would go bid, 43.75 would go bid. Can't staying bid means they come in and they buy it, Mark, and it goes from offer to bid back to offer again. They just can't keep it bid at that particular price.
All right, just a couple more questions and then we'll move on. Can you go back to the footprint chart? And Ron is asking, he says, so the buyers hit the offer at 73.43 and the sellers hit the bid 44.44. Is that correct? He's talking about quantity.
44. That's exactly correct. They lift the offer, and let me just circle it with a pen so everybody can see. They lift the offer right in here and are aggressive buyers to the tune of 7,343 contracts. They hit the bid to the tune of 4,444 contracts, or aggressive sellers. So if I were to take the footprint and divide it in two, the right side of it is aggressive buyers, the left side is aggressive sellers. The reason why it's green is because there were more aggressive buyers than sellers. The deeper or darker green, and your settings could change, it could go blue or whatever. I think green and blue is the color of choice to distinguish aggressive buyers. But the bigger the imbalance, Mike, the deeper or darker green it'll be. Now, if I just look at this number in here, even though that's a huge imbalance, there's not a lot of volume there. It doesn't really affect what any kind of analysis I'm trying to do. But when a market marches up and I see a lot of passive sellers are starting to absorb those aggressive buyers. And there's some big ones because I look at my filter chart and I see some big sizes trying to lift that offer. And it's like someone standing on it and saying, no, this is it. And the market probably couldn't stay bid in this case, giving you a tell to either cover along or maybe get short.
Okay, so that's all for right now, and then we can keep going with the slide.
Sounds good, and those are good questions because, again, if you think about it, it's like anything else. You have to know what seems very logical, but when you get into it and you start to understand, wow, the market had to stop me out, and then it went. So guys will get long, and the market just hangs there, and all of a sudden you get stopped out, and then it goes. It's like I get stopped out. Anybody who's traded for 5 minutes or 5 years or 25 years has said this. I've said it. I had to get shook out, and then it goes. That's not the market versus you. It's nothing personal. It's just there were too many longs. If there are too many people long right in here, what does that mean? That means there's a lot of resting sell orders above the market. Why? Because too many people are long. So all those resting sell orders are keeping the market from going up. As soon as they get shook out and their sell stops get executed, then all these resting cells disappear to cancel. Path of least resistance is up. Why? Because there's less resting cells. That has to make sense like it's the back of your hand. If it doesn't, this webinar will do it. Rewatch it and rewatch it, because that's the functionality of a market doing what it has to do in order to exist, and that is shake out guys when there's too many longs or too many shorts. And when you can get that market action on the highs that's representative of stuff like this imbalance or a big buyer getting stuck like that, it starts to give you the best sense or clue that the highs might be in. So that's why those are good questions. So let me go back to the slide here. Another quote I put in here, Mike: trading is not about being right, but it ties everything in. It's about where others are wrong. Everyone's always worked up about where am I right, where am I right. If you're worried about being right, then it's hard to admit that you're wrong. So everyone gets stressful, not necessarily anybody in this webinar or in your forum, but just traders overall are worried about being right. Therefore, it's harder to get out when you're wrong. Just worry about where others are wrong, where you catch these stuck traders and where the emotion is. We're the guy that comes in with his $10,000 Rolex, but you're going to get it for $2,000 because he needs the money. And that's the thing you constantly got to be looking for on charts. Let's move ahead and let's get rid of these drawings here. What is this? It's a crowded room. It's just a cement with a picture, the story I'm trying to tell you guys, how important order flow is. These people don't realize they're in a crowded room until when someone yells fire. Then all of a sudden people are going to realize not only how many other people are trying to get out, but nobody's going to know where the exit is. It's okay to be in crowded trades, just like a crowded room, but stand right here by the door. If you're in a crowded trade, this is where Anthony's going to be standing. Big Mike, you're probably standing right on the other side, or he's probably in the hallway. But the thing is that this always happens. This is indicative of a high or a low being put in, is this crowded room mentality. And that's why I put a picture on it. This guy doesn't know that there's a lot of people long with him. He also doesn't realize that the darn exit is so far away with a lot of people in front of him, and yet he's long, and he's long from the dead high of the day. And the market or the trade's getting too crowded. So know where the exits are. Where the doorway is in this metaphor is where the stops are. Because for the most part, a buy stop or a sell stop is getting people out of a losing position, or it's a trailing stop. Either way, that's predominantly what most buy and sell stop orders do. Yeah, you could open a position with a stop, but most of them are used to get out of a losing trade. That's what the doorways are in this metaphor or this picture. It's not this guy's fault, or actually it is this guy's fault, not realizing there's so many other people along with him and realizing he's in a bad location, right? If you're going to be long, be with Big Mike or myself here in the hallway or by the door so you could slip out before everybody else tramples over each other. That's what location means. When you're in a good location and you're wrong in the market, you don't lose as much money. It's easier to manage your risk. When you're long and wrong in a bad location, you tend to get run over because you can't get out. There's too many people long and wrong with you. So always know and always sense whether or not you're in these crowded trades, no matter what program or analysis or strategy that you guys use to create your bias. Always know that that bias is going to get you into trades that sometimes too many other people are in, and sometimes that's why it doesn't work. And that's why it's important to pay for your trades by scaling out. I don't know what your profit targets could be and what you look for. That's not what this webinar is about. What it's for is to make it easier on yourself by controlling your emotional capital, by scaling out of winners so you pay for trades. It's easier to stay in for the deeper profit target, right? To stay in when a room gets crowded because you've already got out for a nice 4 or 5 tick winner and you're looking for 12 or 15 in the S&P, but you've already more than paid for the trade on that particular size. But either way, you get the visualization of crowded rooms, crowded trades. This is what moves markets. Rooms, just look at it like a hallway, a banquet hallway, and there's rooms attached all over on this hallway, and some are crowded, some are not. And our job as traders, good traders, is to know, I'm not going to go in this room. Or you know what? I'm going to light a match, throw it in this room, and then run out. Those are the quick winners. And that's what trading is all about, because you're taking money from other people. One thing, anytime I come across this, and I got to say it, replace the word make with take. You're not making money in this business. You're taking money. If you want to make money, I tell people learn how to dig a ditch and get paid $10 an hour, and at the end of a day, you might get $80. Trading is about taking money by finding where the emotion is. And so just keep that thought process in your mind. You're in a helicopter above a bunch of sheep. When they get caught in a herd, you identify the cliff is where the opportunity is. And it doesn't matter what other technique you might use. If order flow and where trap buyers and sellers aren't one of them, you're an outlier to every professional trader I know. I know 2.5 dozen professional traders throughout my career. And if I lined them up on a wall and you guys were to ask them, do you use order flow and what Anthony's talking about? All 30 would say yes, 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 yes. If you said, do you use Fibonacci? You might get one guy say, yeah, I kind of look at it, but you wouldn't get 30 yeses. Do you use value profile? Yeah, it's probably the second more popular theory or technique to use, but not all 30 would say it. Do you use order flow to identify big buyers and sellers in context where they come in a move? 30 yeses. Let's erase the drawings and go back to the slides. So let's take what we've talked about in a traditional dome, which is the one you see on the right here, which is MarketDelta Trader. And again, what we're looking at, and I think this was actually a picture I took off of today's market action, is this is what you typically just see in most traditional price ladders. And you're not able to readily, with a good visualization, see where guys might be getting stuck long and passive sellers are stepping in, or any context of this order flow. And again, the footprint equals order flow. Every time I say footprint, think order flow. So if I pull up the next slide, it's hitting this arrow right here, and it opens up the left side of this dome where you tie in a footprint next to the ladder. So you not only could keep track right at this particular moment, aggressive buyers and sellers, and remember, let me go back to the pen. If I took the footprint and divided it down the middle, aggressive buyers on the right, aggressive sellers are on the left. Same thing with this box, aggressive buyers on the right, aggressive sellers on the left. You're not only able to keep track of what's going on right now, but you're able to look back. This is, I think, a 2-minute footprint bar chart. Every 2 minutes a new bar forms, obviously, and you're able to look back to see, well, where did they come in aggressively selling it? And you could see a dynamic play out when the high was 91.50 today. You could see these aggressive buyers having trouble getting it to go bid, and they get it and they come in, and all of a sudden someone comes in here and aggressively sells it. And he gets the market to rotate lower. That's going to be an important not only price in the very near future, like in 5 minutes or in an hour, but it's giving you a sense of where to maybe cover a long. Say you're long from 87 even, and you're looking for, 150 ticks. But you see this dynamic and you say, you know what, I'm going to scale out here. The market is showing me where it might be getting a little toppy. This is the present, mind you. The past, the present, the future. This is the present. You could do all the homework in the world to try to understand where price might go, stop, and go the other way. You could do all the homework and all the prep work in the morning you want to do, but you're not going to know that at this particular price that they might have come in. You might have thought it might be getting a little heavy at that price based on some other analysis, but this is the execution of that bias. The footprint and order flow is the execution of your bias. It's a sense of calm when you come in and you trade. And I know this happens to everyone in this room, in this webinar. If you have a live trading account, everybody feels like this or has felt like this. You get anxious once it starts getting to your price where you're gonna put something on. And if you have a little sense, a lot of sense of calm will come over you when you know that you're going to incorporate this element into that decision-making process. You might miss some trades, but what you're doing is you're increasing your odds of catching a better price because you're using this thing called buyers and sellers. And, at the end of anything, it's buyers and sellers that move price. More people who want to buy, price goes up. More people who want to sell, price goes down. More people who bought and now have to sell that product, where's price going? It's going lower. If you wanted to buy a car and you knew everybody who bought a Mercedes on Monday had to sell it on Friday, and you sat out in front of the dealership and you seen a lot of people came in and bought that car Monday, Tuesday, Wednesday, Thursday, a lot more than average, and they had to sell it on Friday, you're going to get your best price on Friday, right? Which is a low price when you're a buyer. Why? Because you read order flow. It's not a great example because not everybody has to sell a car 4 days after they buy it. If they did, just like an S&P future, that's how you establish price fluctuation. So there isn't anybody out in the world that's ever traded that ever debates this technique. How to read it this is not just a starting point, but it's just more than an introduction of identifying the market action, the price action, but then knowing what to do with it because you know the right questions to ask. Big difference between this environment and this dome here on the left, which is version 2 of MarketDelta Trader, and this one, which is also version 2. I just collapsed the footprint capability next to it, but so much more information. And you could toggle how wide or small you want this window here to be. But again, it's not just the tool, it's how to use the tool. And you have some real pretty tools that'll sit in your garage, and if you don't know how to use them, they're useless. But if you know how to use something, it could create an enormous edge as far as being able to build that deck better, to cut down trees better, or to find better locations to get long, to get short, to cover the long, to cover the short. I would imagine, and this is just by working with a lot of different people, talking to people, that a big problem is not just getting in a trade, but getting out of a trade. Letting too many nice winners turn into scratches or losers. That's killer. That's a recipe for failure if your account's hanging around zero, but you have a lot of nice profits that you see diminish. And so that's the emotional capital I talk about. That's the difference between a professional trader and a guy who's looking to hit home runs. And not everybody's cut out to hit home runs. Not everybody's cut out to stay in a trade for 20 ticks. Yeah, there are some guys that could do it, but not everyone's cut out to do that. That's why every team in baseball doesn't have 50 home run a year guys. They just don't. But you can make a lot of money and be very successful by getting base hits and doubles and triples. And this is not, by the way, a scalping technique at all. Scalping is making 300 trades a day, looking for 1 or 2 ticks each trade. This is not that. This is identifying the ability to create a bias and then execute it. And that's what's kind of important. Mike, do you want a couple questions right now, and then I'll go to the next couple slides?
Yeah, some of these questions are all over the place, though, so let me know if you'd rather answer them at the end. Let's see here.
That's no problem. Go ahead.
Kulu is asking regarding, this is back a couple slides ago when he had a second footprint on the left. He says, how do you create that second footprint on the left? He's talking about the one where you filtered size.
Let me go back to it. I take it he's a MarketDelta chart user, and so it's an option that, and I think in a slide or two it'll answer that, Mike, because you could take advantage of and come to the room. But the thing is that I have on my charts in any market I trade or look at, I'm always looking at what I deem to be bigger size. So it's just a functionality to add a technical or add an instrument, and then you strip that instrument down into what volume you want to filter out.
Okay.
But that's, every chart I use, Mike, has that. Go ahead.
On a similar topic, Joe's asking, what size do you consider big in the ES, 100 contracts, et cetera? He's also asking, is it more important to see 2 trades of 1,000 contracts each or 20 trades of 100 contracts?
Well, here's the thing, and this is another good question by Joe, is that the CME reports trading and time and sales differently. And the thing is that First of all, to answer your first question, a couple hundred contracts and greater. I like to see when you see this number right in here, accumulation of a few 200 lots. Doesn't have to be 1,000 lot. It could be a few 200 lots. There's really no answer to what's more important to me, 5 200 lots or 1,000 lot. All I know is some aggressive big buyers are lifting the offer and they're not really getting this market to rally like it should. It's just hanging there. Then you could be certain that the CME does report where you can get a whole bunch of one-lot traders that are clicking and lifting the offer at the same millisecond. And that's invaluable too, because you're getting all these guys stuck or buying it. And now they're all looking at each other like, okay, what's next? I bought it and it didn't go up. Then I'll get the question, Mike, and this is a good question, and there's a real good answer to it. Like, well, Anthony, how do you know they're getting long? Maybe they're just getting out of a short. And the answer is, you're right, I don't know. But either way, it's an invaluable tell, and here's why. A market, when there's a lot of people short, a market will tend to keep grinding higher until you get most of those shorts shook out, and then it goes lower. And the reason is because they all had their bids. Let me draw it here on the right so you guys can see it. Market rallies, and you got still too many shorts in it, and it just grinds higher. And then you finally get that little capitulation move higher, which is indicative of getting every last short that got short all down in here to puke. Then it goes lower. Why? Because as soon as you stopped out all those shorts, they canceled all their resting bids. And what does that mean? Less buyers. Less buyers, it makes it easier for a market to move lower. So you have to shake most of the shorts out in order to go lower, if that makes sense. So whether they get stuck at the high or you finally shook out the last of the shorts, it's indicative of a market that's going to roll over and go south.
A quick question of my own. So I've done some analysis on ES over the last several years, and looking at every tick, and the average size is very small. I don't remember exactly; it's somewhere on the form, but let's say it's 4 or 5 contracts. It's to the point where I can picture Goldman out there doing 1 and 2 lots. They're obviously they have these huge iceberg orders, but how do you rectify the average size being so small with your filter of looking for a relatively large size compared to that?
Well, here I'm looking at when you see just an influx, like a log jam of all those 4-lot, 1-lot, 2-lot orders coming in at the same time reported, and you just got a huge uptick. Everybody ran in to try to lift the offer at the same time, and it's just that rush. So that's one way, right? I realize that. Go ahead.
Sorry, are you aggregating it, or are you looking at only ticks that come across that have more size than your filter?
Just size more than my filter, and that's all I'm doing. But whether it's aggregated or whether they're reported as one buyer, Mike, it doesn't make a difference to me. I'm using the information the same. So I understand people come in, or institutions rather, come in with different software. Like one of them isn't just the iceberg. One of them is a growler where they keep coming in with smaller size to hide essentially what they're doing in an aggressive style or a passive style. All I want to see is when you can get this big aggressive style come in the context of a move. And when you use those two, so big buyers coming in at what might be the tail end of a 4-point rally is information for me. Because remember, and you know this, Mike, from trading all these years, that a market rallies like this, we don't know if the high is in real time. We never know when the high is in. But it starts to become a safer bet when it rallied from this X to this X, and that's 4 points. And you know as well as I do, the ES doesn't move in straight lines. It doesn't rally 10 points in one shot. There's rotations, there's pullbacks, and being a contrarian guy, which is the most popular strategy of every guy, like I mentioned before, it's because of this scenario of this is the emotion that comes in. So I hope that answered your question.
Yes, and let me ask just a few more here. Let me know when you want to move on. Charles is asking what chart styles you use the most, tick, volume, range, etc.
I use, and this is again a webinar for a whole another day, I use point and figure. And I do it, and you know, I found that there was a lot of people that didn't understand, and I don't want to get into exactly when a new 4 PNF bar or PNF bar would pop in. Like we know, a 5-minute bar every 5 minutes, a new bar starts, right? The 4 PNF, it's simply this. Market is rallying in here. The first time it pulls back 4 ticks from whatever the high print was, it'll pop in a new bar, which would be this bar right here. We'll call it bar number 2. So then you're able to take if I was to take a pen like this and draw a line chart, it shows a retracement, a re-rally, and then a big pullback lower. So you're able to get truer rotations. I did an in-house webinar just for room guys just last week to show that it's not only context, it's true rotations, because every market has rotations that are truer, meaning I think 4 ticks, 6 ticks is a true rotation. It's a popular rotation in the S&P. I think when you look at the oil, I think it's 10 because it moves in dimes like that. But the whole point is that when a market starts down in here and it rallies up to here and it starts to hang there and stall out and then it breaks back down, why is it important to know where a market started? Because you know that for the most part there are no short-term traders that got long better than here, because that's where it started. So you know there's no traders that got short better than this price, because that's where it stalled out. And that's important, because you know, if you can kind of assume where guys start getting in, you know where markets want to go back to. Markets always want to go back to where most guys got long or short. That's another emotional attachment. And I explain it like this, Mike. If you traded today and you only made 2 trades, and both trades were buying 88 evens. 88 evens is unique to Big Mike, right? So if it's unique to Big Mike, and a lot of people got long in 88 evens, then it's safe to assume that it's unique to most of the rest of the market. And so if 88 evens are down in here, Mike, and the market rallies up, and you make 4 ticks, 6 ticks, 8 ticks, and all of a sudden it comes down 7, 6, 5, all of a sudden you're going to get a little emotional because you've seen a 10-tick winner now turn into a 4-tick winner. You feel like you lost 6 ticks instead of making 4. And then you see it come a little lower, all of a sudden you go, I'm not going to let a 10-tick winner turn into a loser, and you get out for a scratch. Why? Because that price was unique to you just based on the fact that that's where you opened up your position. So if people understand that what's unique to them is also unique to most of the rest of the market, and you could start looking at footprints and see where and identify where people might have got long and short, then this same dynamic that I just ran through applies. That's why markets like to go back to heavier volume areas and react to them. There's another dimension to that I won't get into, but the fact of the matter is markets like to go back to what is unique to them. It's not just heavy volume, but what's unique to them for that same rationale that I just walked through.
Okay, a couple more questions. Let me know when you want to move on. Jonathan asking, or actually commenting. Sorry, go ahead.
That's all right. I was just saying, let's do one more and then we'll move on, and then
okay,
and then go from there.
He's commenting that footprint charts make scalping for 3 to 4 ticks very tempting. From your experience, are there good odds for successful scalping on the ES with footprint charts? And he wants to know what a reasonable risk would be for scalping 3 to 4 ticks.
Well, here's what I convey, and again, an excellent question. You know, people told me, Mike, that you got a really good forum, and there's a lot of guys that, and I can kind of tell by the questions, you know, guys have a better sense, I think, of what to expect or what to look for, and I could tell by the logic or the rationale of these questions, because a lot of times with questions, when you pay attention to them, the answers are in it. So a couple things with this question. Scalping, and you got to be careful how you define scalping. Yeah, it makes it tempting, and here's how you find a solution for this, is you don't just get in and out with the whole, again, if you're just trading one lots, you have no choice. But if you could find yourself right and accurate to the tune of 3 or 4 ticks a lot, then it's easier to build your size. Then it's easier to say, I'll just take one contract out at a +3 or a +4 tick winner. So if I buy a market at 84 evens and I get out, let's just say you do 3 lots, and I get out for a 4 tick winner on one of them, now you feel better. This is what I call paying for the trade. You could call it scalping or anything else, but you feel better, you paid for the trade, you bettered your entry, and now you could look, and it's easier to stay in the trade, stay through the shakeouts for the +8, the +12, the +5 million. It's always easier when you pay for it along the ways. But if you can't find the first 4 consistently, then how are you going to find the next 24? And people think, this is a misnomer about trading, is they think they make more money by looking for more ticks. You make more money by finding the sweet spot of profit targets and slowly increasing your size in which you participate with. Nobody will debate that 20 tick winners are hard to get. They're hard to stay in for. So there's a big difference between trying to get a 20 tick winner with 1 contract, all right, or trying to get, let's say, a 5 tick winner with 4 contracts. It's a lot easier to get 5 with 4 than 20 with 1. And people would rather be in this scenario, and the reason why they'd rather be to trade 1 is everyone looks to do, and again, not a reflection of this forum or this webinar, but people in mass would rather do the least for the least. If you ever ask someone, would you like to make, 500 grand a year and do nothing, or make 4 million and actually work 8 hours a day? Everyone would say, give me 500,000 and let me do nothing. And again, that's not a reflection of me, you, or anyone in this room, but that's why this dynamic plays out, comes to fruition. Because everybody looks at a chart and says, wow, market rallied 5 points. If I could take 4 points out of that, that's 16 ticks, that's 20 ticks, and I do it with a 1 lot. I could trade with very little risk and everything else. Risk management isn't the size you trade. It's how you exit your losers. A lot of people risk more with a 1 lot than they do with a 3 lot because they put a 1 lot on, it goes against them, they put another one on, and they get into that adding mode. They become complacent and sloppy. So don't use the number of contracts you're trading just as the only barometer as to how you're managing your risk. Again, build your size, look for the sweet spot of rotation and what the market gives you. And the sweet spot of a rotation is not 4 or 5 points in the S&P. It's just not. Could you get 20, 30 tick winners? Absolutely. But you got to start by getting your 4 and your 5s, scale out, and work yourself in that direction. But remember this, it's always about making trading slightly bigger, Mike, but looking for less ticks. And the scientists would say to me, yeah, but trading a 3 lot is 3 times more risk than trading a 1 lot. Yeah, but not if you have a problem with adding, and because you're looking to make $1,000 a day and you're trading a 1 lot. I tell people all the time, you better keep your reward goals and your profit goals in perspective. If you're looking to make $4,000 or $5,000 a month and you're a 1 lot trader, I got 2 words for you. Good luck. It's very difficult to do. So keep it in perspective, and don't grow size because you want to make more money. You grow size because you're trading better. You trade bigger when you're trading better. I hope all this makes sense. There's a lot of things I'm covering that are important and they're good questions. It's the elements of successful trading, Mike, are these. Know what other markets are doing, know where big buyers and sellers are coming in, and also know how to pay for your trades. And don't look for doubles and triples and home runs. And a 20-tick winner is a home run in the S&P. When you get them on the last third of your size and work into it. I hope that kind of addresses not only that question, but a lot of either questions or concerns, whether they're being asked or not, because everyone backs in. The path of least resistance is, how can I make 20 ticks with the least amount of risk is absolutely possible. And everyone jumps down to 1 contract because, just by process of elimination, 1 contract is the least amount of risk you could possibly trade. But don't confuse the size of your trading, that you're opening, closing a position with risk. Do I advocate that people start trading with 3 lots and 4 lots and 5 lots? Absolutely not. You got to earn the right to go from 1 to 2 to 3 to 4. However, that should be your goal, and not stick in trying to trade ones and make a lot of ticks. Work the other way around. You mind if I just go on, cover the last couple slides, and then we can touch back to questions?
Yeah, there's about 20 questions here, and most of them are kind of all over the place, so it's best we hold them to the end.
Sounds good. There's only a couple more slides, and I think, let me get rid of some of these drawings so we're not distracted here. So I went over the Dome and how version 2.0 with MarketDelta Trader not only allows you to collapse the Dome, so you're looking at either the Dome on the right or the Dome on the left. You could actually collapse how much real estate you want to use with the toggle here at the bottom. You could just look at one bar, right? You could look at just volume. There's a lot of different functionality. I don't want to turn this into a MarketDelta Trader orientation, but it's important to realize that big differences between first version of Trader and the second version. Throwing the bids and offers on separate columns. There's always been one-click functionality, which you need, but having this information to your left saves you the ability to have to reference anything else. I use charts to reference. I watch Domes and I use charts to reference what other markets are doing and where these guys were stuck, long or short. Well, we want to talk about this room, Mike, and I won't spend any more than just a minute on this slide. I'm going to put in a link, Mike, if you want to share it, you can, with a 2-day guest pass for your forum guys that attended. If they want to come and check out the room tomorrow and Wednesday, it's up to them. But it'll allow you to see, instead of just pictures, you'll see this bias that I'm helping people start create today. You see it executed, right? And you'll see how, in real time, how I watch the footprint and use it as order flow. There's a big difference between a presentation and slides and real-time analysis. And so take advantage of this link if you'd like and jump in. I'm going to put in a link in the chat window. There's a lot of webinars I include once you guys sign up, but I don't want to get into any of that. I just want you guys to know that there's access. If Mike wants to pass it off, that's up to him. But again, it goes back to, this is a big pillar of successful trading, not just knowing where these guys are at, but knowing what to do once you see them. There's the next pillar is market relationships. I don't know a trader that's professional, that's successful, that trades the S&P and that's all they look at, or trades the Euro stocks and that's all they look at. Does not happen with guys I know. So that's a market relationships pillar. The other one is this order flow, and then a kind of like a 2 and 2A. 2 would be order flow, 2A would be where guys are stuck. They're kind of married with each other. So I think that if you guys want to tackle some more of these questions, Mike, this would probably be a good time to do it. And I didn't pop the link in just yet, but I'm going to do it right now. But go ahead with your questions, Mike, and then I'll take them.
Yeah. Let's see. Okay, so if anybody has questions that they need to ask, go ahead and do it now. I'm going to go ahead and take some of these other questions that are on the screen, and just so everybody knows, the first question is from 30 minutes ago, so it gives you an idea of where we're at. Buster's asking, what about if you see a huge imbalance in an area you consider or you do not consider significant? Would you be inclined to trade that?
Yes, absolutely. Now, how big or how much am I inclined? Are there other elements? Absolutely. So I have a thing that I put out, my own levels. Let me go back to that. Let me go back to that imbalance that you see. So Buster's asking, if I see an imbalance and it's somewhere I don't have a predefined level of resistance, would I be inclined to trade it? Yeah, I would give it a look, and I would base it on what other ancillary markets are doing, right? I'm a big inverted guy with the bonds. So if the bonds go bid, which means they go up 2 ticks, and I see this big imbalance where I think guys are stuck long in the S&P and I see the bonds go up 2 ticks, that's invaluable information as to what's going to happen next. That's how you polish your predictive skills. That's like the radar or the Doppler radar for meteorologists, knowing that the bonds just rallied 2 ticks and the S&Ps could have guys stuck long on the highs or with an imbalance. And if you're not looking at those things, and you don't have to have your head spinning, but if you just know what to watch, now you know you're doing what every trader I know does that's done this for a living.
Chris is asking, does this work in any futures market or only certain markets?
This works with anything that has price attached to it. So if I went to Target, it would work on T-shirts. If I seen at Target that there's a lot of people wanting to buy a T-shirt, and so did I wouldn't buy it. I'd go to Walmart. Or if I seen Walmart had the same shirt for $10, and that shirt's 15 at Target, I'd buy as many at Walmart, go to Target, and sell them to those people. You can't do that with big box stores, but you could do it with any futures stock. Anything with price attached to it always is going to adhere to the basic supply and demand technique. And then relationships. One analogy I use in a lot of my webinars I did today is, there isn't a bank in the world that will finance a house unless they compare it to as many comps as they can, and that's what an appraiser does. He looks at a 4-bedroom, 3-bathroom house and says you're going to buy it for $400,000, but the last one that sold was last year and only sold for $200,000. Bank's not going to finance that deal. It's all about comparing, contrasting, and buyers and sellers that move anything with price attached to it.
Ryder wants to know about high-frequency trading. He says, how do you deal with it, especially if the HFT bots are moving 20 to 30 ticks? I'm not sure I agree with them moving 20 to 30 ticks, but a lot of people have questions about how high-frequency trading impacts a discretionary or small retail trader.
I didn't catch that very first part of that question, Mike. Could you repeat it?
He just wants to know how you deal with high-frequency trading bots in the market.
Well, with the footprint, that's the difference between like 04, 05 and when they started getting introduced and really started to hide their orders. And then the thing is that they're stealing the tick. That's what high-frequency traders are doing. They're trying to buy it at 2 and sell it at 3. And if they can't get it to fill their 3s, they scratch their 2s. And they're able to do it 5,000 times faster than the blink of the eye. And you know what they're using? The same techniques I'm talking about. Only I'm not saying to steal a tick, try to buy 2s and sell 3s. I'm just saying that with them, if you're trying to steal a tick with them, you won't compete. So you have to broaden your time horizon and say, while I'm not going to look for 20 or 30 ticks, I'm going to look for sweet spots of rotation and see where other guys are stuck, and realize I'm not going to compete and chase these guys for a tick. I'm not going to beat them to that tick. So that's where it's important, because they'll get out of losers quicker than you and I, right? And they're looking for a tick. So you got to understand what high-frequency machines are doing. What they're doing, there's really not a ton of logic that goes into them. It's all about speed. It's literally about having a server on top of the CME server so that when they see 3s trading and there's down to 200, they can come in and steal the last 200 because they see the SPY also go bid, and you didn't even see it because it happens 5,000 times faster than you could blink your eye, and they're able to buy 3s as it goes 3 bid. Now they're long bids, and they're just trying to be long bids and short offers, and then scratch the ones that they can't get filled on the tick higher. So as long as you know that you're not going to compete that way, then you just, again, elongate your time horizon. And again, you'll always have, it's not just retail guys that get stuck long and short. It's could be anyone. And stay away from trying to race these guys to steal a tick here or a tick there.
Barry wants to know if you personally have an audited track record, and I get asked this question too every now and then. So do you want to give us your tax returns and everything?
Mike, your volume went way down. You still hear me, Trevor?
Yeah. Can you hear me now?
Hold on, Mike. I gotta adjust my volume. It went way down.
How's that?
How about now? Do you hear me?
Yeah, I can hear you fine. You hear me?
Okay, good. Yeah, I can hear you now.
I was just saying Barry's asking a very typical question that I've been asked a lot. A lot of people, anybody that people think are profitable, they want you to prove it, right? So Barry's asking if you have an audited track record Maybe you'll give us your tax returns, etc. How do you respond to
Barry, if I showed
that?
you, here's how I respond to it. If I showed, not necessarily Barry, if I showed someone a month, they'd say, oh, that's just a good month. If I showed them 6 months, they'd say, well, maybe he just had a good half a year, a good run. If I showed them 5 years, they would say, he's probably got 3 other accounts, and he's doing the opposite in those accounts of this account. So I don't get into proving anything to anyone. That's the whole thing. People who want to see, and it's not necessarily Barry, they have to have every single duck in a row and proof and evidence that a guy does what he practices, what he preaches, then they're not risk takers. They're not ones, because every duck isn't going to be in a row to buy it at 3 and sell it at 2. And so if you're looking for absolutes, you're in the wrong business. You should, chemistry is probably a better field. And this is not directed at you, Barry, but anyone that's just has to have exact proof. Proof is you come, and guys that come to a seminar we did a few weeks ago, traded live in front of them, right? Guys in the room hear me call out every trade I make live, right? It doesn't matter if I make money. What matters is, can you take the information and make money for yourself? I could show you great statements, and you'd be great. Does that make you more money? No. It might actually get you like, well, I can't compete or do what he does. It has nothing to do with what I do. It's, can you take what I talk about
No,
and understand the logic?
It's totally the wrong question to ask, and it's been covered so many times on BMT. There's a thread that the title is something like the guy has spent $10,000 in education, he's unprofitable, and then through the course of this thread, he basically says that no one can make money trading because he can't, and he questions everybody, and it's totally the wrong question to ask. And I think that anybody that's focused on that is focused on the wrong thing. So I would highly encourage everybody that's thinking that way to reevaluate. Okay,
and I agree 100%, Big Mike, with you, and I would add that I understand the concern, because in that first slide, one of the first slides I showed is that people get introduced to this business and they might have spent a lot of money and got burned because they feel that randomness is still front and center, and there is no cookie cutter way to become a doctor or a lawyer in trading. There is to be a doctor or a lawyer, but not as a trader. So what you have to do, and what I tell people is, listen, I don't guarantee people make money. I could almost say with a high degree of confidence that you'll have your best chance at being consistent by understanding that you've used these principles in everyday life. Anytime you bought a car or a house, I'm just making it applicable to the S&P mini futures and crude oil and gold and the 6E and a T-shirt at Target. It doesn't matter as long as it has price, it has buyers and sellers, and it's just a matter of what does that look like on a chart and what are the best charts to look for that. And now to put them together with a platform and a dome, you understand that the logic you guys already know, just making it applicable to trading.
Okay, let's move on. Merritt is asking, do you use the footprint to tell you when your trade or premise is invalidated? So not just for potential setups, but also when you should get out of an existing trade.
Absolutely, absolutely. When I, cover a winner, and let's say I'm looking for, I have a target of 8 ticks, and let's say I'm long from the fictitious price of 3, and I'm looking for 11s to get out because I'm playing it to a target where I think the market's going to rally to 13. I'm playing it a couple ticks in front of that. I'm long at 3. I'm looking for what ends up being a +8. Well, guess what? If I see this market go to 9, 10, and see those techniques and some of those examples and that dynamic to play out, and guys in the room will attest to this, there is no difference between a +11 and a +10. Anybody that says that's one tick, well, how about the time that you missed the 11s, you missed the 10s, the 9s, the 8s, the 7s, the 3s, and now you took a 2? What's the difference between a 10, 11, and a 2? Now it's like 10 ticks. So that's information that's invaluable, and you look for it and you see that guys are starting to get stuck on this move. Just because you're looking to get out at 11 doesn't mean that the past, which is your profit target, or the reason why you're getting out at 11 doesn't mean that something in the present can't change that. The footprint order flow in this information is the fact that the market, and it would be the hand coming out of the screen and hitting me in the head and saying, what are you doing looking for 11s? Can't you see these guys getting stuck at 10? Take your plus 7 and walk away. There's no difference between a plus 7 and a plus 8. And people laugh in the room and say, oh, that's one tick. But remember, it's always about emotional capital. And you'll never, that's, the saying, you'll never go broke taking profits. That's where it's applicable, right there.
Right. Robert wants to know if you're using footprint for confirmation.
I don't use the word confirmation necessarily. I use it for the hand waving at me and saying, here you go. This is the price. I'm just afraid to use, I don't want too many things to confirm, or just like I don't like to use the word homework, because nobody likes homework. I don't spend 2 hours to prepare for the day. I know what to prepare for. I know what's coming out, and I know what levels I have out. So I might spend 15, 20 minutes, and then I use the present to prepare real time. The same thing goes with when you're looking at confirmation. Sometimes you'll never have enough confirmation, meaning, a couple things line up fine, but when there'll never be that 100%, this is the place to get long, we're going to rally. And when you feel like that, sell it because it's going down. So I don't like to use the word confirmation, but I guess for just answer's sake, yeah, I look for it as the wave of the market saying, okay, Anthony, this is probably a good price to take a shot.
Yep. Just so everybody knows, currently asking questions from 30 minutes ago. Ryan's asking a question that I see all too often on the forum. I see a lot of people, newer traders especially, that will move a trade to break even after a certain point. Any comment on that?
Well, I mean, that's very subjective. I mean, you could sometimes break even if they're good. If you're using good reasons to get in, then break even matters. But if you're just, sometimes people, they get in and all of a sudden they get in maybe, and the reason to get in was what ends up being arbitrary, so they're just using an arbitrary exit. So break even is fine from an emotional standpoint, but there's a lot of subjectivity where how far did the market go, what's underneath you, is how much did you scale out of. I would rather get out at break even, Mike, than anybody that does a break even plus one. Break even plus one is just showing a lack of knowledge because, I just want to be right and take something out of it. To me, that doesn't matter. It's all about not losing money, not making money. So I'd rather do a break-even minus one than a plus one. I don't care. I want to stay in the trade, give it a little bit more room to breathe because I already paid for it. This is all about, am I going to make a little bit more money, or am I going to take a scratch, which is a break-even or a minus one? But anybody that does a break-even plus one, they're a little less secure about just having it to be a winner. And maybe they're trying to dress up their statistics or feel a little bit better about it. Yeah. It's all about context, and it's all about preserving your emotional capital and paying for your trades. And there's a lot more to that question.
You're trading on emotions instead of on facts that your chart is telling you. Joe's asking, he wants to know, in a market that's very strong, if you only look for washouts that would position you in the direction of a trend, or he's asking, do you only look for washouts that would position you in the direction of a trend? For example, a very strong day with a washout to the downside, then buy. So he's talking about, to shake out all the weak hands.
Yeah. Well, any semblance of like capitulation.
Right.
Yeah, but again, washouts could be subjective. It could be just a bloodbath washout to the downside based on whether it was the Boston Marathon bombings a couple weeks ago or any other kind of terror threats and that kind of washout, which might have some legs behind it or might have to wash out some other longs, or like a day like today, which was kind of just a grind. You kind of just look for a tiny bit of capitulation and tempo. I like to call it tempo. Here's the example I use, Mike, is that I use a lot of analogies to convey a point, and it gets people to laugh, but it also makes sense. Rejection is what a washout is, right? You know that a market, when it capitulates or washes out, it bounces, it's just rejected. So I use the bar and I'm trying to get a girl's phone number at a bar. You buy her a drink and she kind of likes it, and maybe she'll go out with you, maybe she won't. You don't know. But all of a sudden, if the tempo picked up and she slapped you across the face, you know you were rejected. There's no doubt about that. That's a market having a quick rejection off the lows.
Merritt is asking,
same concept.
Going back to the filtered footprint, he wants to know, why does it matter if it's 5 200 lots, 1,000 lot, or 1,001 lots? Why, why not?
Well, it doesn't
why is
matter.
it different? He says, why are we looking at the fact that the same amount of volume is trapped either way?
Yeah, to me, and I thought I said it, and I apologize if I didn't, but it doesn't matter. All I care about is in that same specific moment, you get a rush of a lot of buyers some guys doing the same thing at the same time, and that's the trap. See, emotions come from traps, right? You got to get people stuck long in order to have a better chance of going lower, right? Because when you're long, you're a seller. When the market's too long, there's a lot of sellers coming. So that's the significance, especially when they're big. Some big aggressive filter is, either a lot of little guys doing it at the same time, or one big guy saying, let me buy 500, either to puke a short or to get long because they missed the momentum. Either way, that's the trap, and that's the emotion that you would identify. Again, if the context was the market moved up, 3 or 4 points, if we're using the E-minis as an example.
Charles wants to know if you can share your point and figure settings.
I don't have it right now to specifically do it. You mean like a chart definition, Mike? Is that what he's asking?
Yeah, I'm assuming.
Yeah, I would if I had my software open and everything else, but I don't.
Mark wants to know, how well does footprint work with thinner products, not the ES?
Again, it works. You just have to, I should say, it works to the same degree of effectiveness. You just have to obviously tone down what you deem to be a big order. And so, and I get people ask me, well, what's a big order in oil? And so the thing is that it could be 9, 14, something that doesn't, let me go back to that filter real quick and answer this question that way. If I go back to footprint, which is this one in the lower left, you want a size that you don't have too many of these orders filling in the footprint, but you have enough. If it's, if it's 0 by 0 up and down, then you probably got too big of a number as your filter. If you got too many of them in here, then you got too low of a number, and you might as well just keep your regular footprint that's showing you everything. So you want like a sprinkle in it. And so, again, it doesn't matter if it's T-shirts or toothbrushes, crude oil or gold. Markets will bounce off lows because finally the market got too short. And it's not just people who sold it bad. It's people who are short, and they got to cover at some point. So let's say Big Mike sold it good here in this circle, and the market's rolling down, and Anthony sold it in this circle, and it's rolling down, and Trevor sold it right on the lows. He got stuck on the low because he couldn't log into the footprint chart, and he didn't see a big accumulation of a lot of other people selling it on the lows. Either way, we're all feeling the same if it starts to run back up. Trevor is emotional because he's starting to see he might be short in the hole. I'm getting emotional because I see what was a 10-tick winner turn into an 8, 6, 5, and people who see their profits diminish. Like the example is a 10-tick winner that now is a 6-tick winner feels like you lost 4. That's just how the mind goes. So that's how I'm feeling as it walks back up. Mike, who sold it the best up here, is feeling the same as it starts to walk back to my price and his price. Diminishing profits starts to feel like a loser. So all 3 of these circles, Big Mike, me, Trevor, all are exiting and creating this self-fulfilling prophecy of people that are in these circles with us covering those shorts, whether they're short good, short okay, or short bad. In any market.
Thanks. Lewis wants to know what products you trade in the daily Market Delta room.
I trade primarily the ES, some bonds, but I watch almost all the markets, not as intently as I'm watching the ES Dome. But there's a lot of, just because I don't trade other markets don't mean I don't watch other markets. So I put levels out for oil, the euro, NASDAQ, bonds, notes, and the ES. But the thing is that I'm watching all the ancillary markets, but my primary market is the S&Ps. That doesn't mean I don't make any other trades in any other markets, but I don't just, it's hard for me to trade two markets. Let's say if I were to make 10 trades, Mike, I'm not making 5 in one and 5 in the other. It's probably making 10 in just the ES and none in the other, or 9 in one. But I'm watching the other markets, even though most of my action is in the E-minis.
Sal is, and you covered this a little bit before, but Sal's asking regarding using multiple contracts to multiply profit with a reasonable price rotation. He wants to know, how do you manage risk when you have multiple contracts that trade against you? Would that not translate to a larger loss because of the trade size? If you make the stop too tight, you'll be taken out because of the trade. You're trading the noise. If the stop's too loose, you end up with larger losses.
Well, that's the phrase sweet spot, is you hang in to give the trade ample time to breathe. So in case you didn't pick a perfect entry, you still have time for it to take a little bit of heat, but it doesn't feel like heat. And everything is relative. So while it might feel like 3 contracts is 3 times the risk to a guy who's trading 1, it's all relative based on the fact of what he's trading, his risk tolerance. What I tell people is, it's not smarter to risk more. It's all about the sweet spot. And people get caught into when the unexpected happens, and in trading it always happens, then what do? When the unexpected happens on the operating table, you want a surgeon that doesn't have to go to breathing techniques from a psychiatrist who told you what to do when all of a sudden you're not feeling really confident. You want a surgeon who knows what he's doing. And so if you know what you're doing, size doesn't matter. Now, I don't advocate everybody could trade 20, 50, or 100, because not everybody's wired to trade that big. But everyone's wired to trade bigger than 1, as long as you know and have a sense of what you're doing. And so the thing is that for me, risk is, and I could say this now because guys have been in the room for a long time and they know this. I don't take big losers. I don't take 7-tick losers and 5-tick losers. That's very odd. And if I do, it's only with the last third, because I manage the first 2/3. I like to be all in and all out with losers. Sometimes I scratch a third, scratch another third, take a -3 on the last third. It's how I keep my average net loser small. But I don't take big losers, and it's not because I'm quick or I'm smart. It's just that I know what I'm looking for, and every trade is not that important. And what happens is, and this is a saying I got, is that if your goal is to make thousands and thousands of trades throughout a career, why would any one be that important? And when you're looking for big profit targets up here, every trade becomes a little bit more important. When you study too hard, this should make people feel good, because I'm not telling you that you have to study for 4 hours before the market opens up, or 3 hours. But when you do too much and you put too much emphasis on a setup, and then it all comes to fruition and you put it on, and price will always be the first thing to tell you you're wrong, and the market starts to come off, all of a sudden, I spent too much time and energy in this setup, it has to work, and you buy more, and the market runs down, and you buy more. And it's because you didn't understand that the better the location, the less the risk, without having to worry about how much size you put on. And also remember this, I say this in the room all the time, I'll say it now, you'll hear me say it again. My best trades, Mike, you know what my best trades, Mike, are? Small losers.
Yep.
My worst trades are missed opportunities. My best trades are not winners. Anybody that tells you about their winning trades is not a professional trader, or that's all they talk about. If someone were, in a prop firm environment, you ask someone, hey, how'd you do today? He didn't say, oh, yeah, I made $5,000 or I made 500 ticks. He's all excited about it. Or he just, don't even tell you what he made. Just, I did all right, missed a couple trades, got stuck on that. They don't come out and talk about the winners. But we will say, yeah, I got stuck and I got, you know, I scratched 2/3 of it, and I should just scratch the whole damn thing, and I took a -4 on the balance or whatever. We're going to tend to talk about our losers. Your best trades are small, or should be small losers. The best trades that you guys should ever have are small losers. You actually should get a thread going, talk just about losing trades. That's it, just losing trades. I don't want to hear about a winner. I just want to hear about how you're happy about taking losers. Get happy about taking losers because you're going to be wrong. And it's hard for humans to admit that we're wrong. I don't care if it's in an argument with your spouse or an argument in a bar about sports. It's tough to admit that we're wrong. And when you kind of transition that into trading, it becomes suicidal. And that's the thing. So losers are your best trades because, hey, sometimes, you know why people don't like to get out of losers? Because it might be a winner. That's exactly what they think. That's what I'll think sometimes because I'm human. We hate to get out of small losers because, hey, this might be the winner. That's laying too much importance on the trade. Devalue the trade. It's supposed to be one trade, tens of thousands of trades you're going to make throughout a long career. Why would anyone be that important? And the answer is, it's not. You gotta. Well, I don't want to get into that analogy because it's kind of a family webinar, but it's all about. We're not marrying. We're not looking for a relationship. We're looking for one-night stands. Get in, get out, and move on. And then you manage your risk better that way. And that's what's important about trading. And people talk about risk management. It's all about the small, short loser.
I agree completely. The better loser you are, the better trader you'll be. And if you look at the journals on BMT, there's a very clear pattern that should emerge, which is it's not the winners, it's not the winning trades that's really dictating the theme of the journal. It's the losing trades that are doing it. So,
well, that was well said, Mike, when you said the better loser you are, the better winner you are. That's kind of what you were saying, and I think that's great. I'd write that down, and that's big, Mike. I mean, that's a threat. The better loser you are, the better winner you are. And people would say, well, what does that mean? And I think that was well said.
Jeff and Stephen are both asking about cumulative delta and using any type of divergence on cumulative delta for trades. Any thoughts?
I inherently do that, and that's kind of what cumulative delta is. And it's again, sometimes you look at what the delta is on the day, and you'll get mixed up in the context. And that's why I like to look at just the actual move, because that's what delta is, right? It's aggressive buyers minus aggressive sellers. And when it's negative, it's more aggressive sellers. So what's important is to ask that second question. It's not just that you see a big delta, but has price moved with a bigger delta? And so that divergence, again, has to be used in context. What are correlated markets doing? Do you have a predefined reason to sell it? Right? So if I have an alert level that's resistance, and I see that the market ran up like this, came off, and price made a higher high, maybe the delta made a higher high, but price is below its high, you might have an element of stuck longs. Again, this thing down in here, this filter, it's the same way to look. It's a different way to look at the same thing, right? So a divergence with like delta and price, a lot of times you see in here, just slightly a different way.
I see a lot of people asking, again, for the chart settings or chart definition. So maybe once this webinar ends, maybe you could email me a link and then I'll post it in the thread for everybody. Would that be all right?
Yeah, I don't have a problem with that.
Let's see. We're getting towards the end of the questions here. Cameron wants to know, he says you mentioned earlier that bonds often are inversely correlated to the ES. Is there anything that's correlated to crude?
There's a lot of things correlated to crude, including the S&Ps. Not as tight as some of the products of crude oil, but oil is, because there's a lot of oil companies and stocks and ETFs in the index, in the stock index, and because if you just look at the logical reasons why would oil be tagged to the economy or to stocks, is because stocks are tagged to the economy. So better the stock market does, the thinking is the better the economy is doing, better the economy is doing, more demand for energy, higher price. China, in particular, because they're big demanders of crude oil. There's other products that I talk about to trading room members about, not just what the corollary is, Mike, but how to use it, how to use a divergence. Someone talked about the delta divergence. I like intermarket divergences, when price makes a higher high in one market but not in the other. But I would start for an energy trader with just a simple stock index, and you'll see they chart similarly, and just kind of get an idea of when they decouple, and you're getting, oil is real strong and the index just isn't. Maybe oil's getting a little heavy,
right,
and you're ready for a turn.
Eric and a couple of others are asking about sessions, RTH versus ETH, 24 or Globex chart versus cash chart. Can you comment on what you use and why?
I use the whole session, and maybe 10 years ago I wouldn't, but because everything is global and there's so much activity in Europe during our overnight session, because I'm from Chicago, so essentially I start trading at 7:20 when the bond market opens up. And the thing is, there's more valuable information with overnight volume now than there was 5, 6, 7 years ago. So that's why I use the whole session instead of just the regular trading session.
Okay, and I think that's actually all the questions right now. So do you have anything else for us? Or maybe you can give us a contact slide if anybody has further questions, how they can get a hold of you guys.
You want me to type it in, Mike, or just yell it out?
Yeah,
It doesn't matter.
Yeah.
Here, let me type in an email address. That'll work.
And the website's MarketDelta.com. And you mentioned I posted the webinar link that you shared earlier in the thread on BMT for people that want to join the trading room tomorrow. And okay, so the email address is tradingroom@marketdelta.com. I'll post that in the thread as well. So if anybody has questions, that's the best way to get a hold of you guys?
Yes,
okay.
Definitely.
Okay, anything else, Anthony?
No, that's it. I appreciate you guys taking the time. And I was serious when I hear a lot of good things about Big Mike's Trading Forum is that you guys have, I could tell it's a no-nonsense forum. And so my compliments to you on that.
Thanks. I certainly try very hard, and I'm very proud of what everybody on the forum has accomplished. Okay, so thanks, Anthony. I really appreciate your time today and for the time it took to prepare the presentation and to answer everybody's questions. I want to remind everybody that I will post the recording of this webinar sometime tomorrow. You can look for it on BMT or on YouTube. And there's a thread, so I've posted the links that we talked about in the thread on BMT also. You guys should check them out, and if you have any other questions, that way you can get a hold of Market Delta to get those questions answered. So, Anthony, I'm sure that I'll see you again on the forum, and thanks for your time.
My pleasure, Mike. Thank you.
Thanks.